Hi everyone, I'm Felix Mercado, producing branch manager and mortgage loan officer for Nations Lending Corporation in Sanford, Florida. And today I am here to answer 13 of your most frequently asked questions from you guys, the home buyers, the first-time home buyers. And so I have my questions here in hand, and we're gonna dive right into it. Question number 1, what is the difference between fixed rates and adjustable rates? There's a big difference between fixed rates and adjustable rates. A fixed rate is set. When you take out your loan, it's the rate for the lifetime of your loan until you refinance or until you sell it and then it goes away. But an adjustable rate is different because it goes up and down. It may fluctuate depending on the terms of the adjustable rate mortgage. Now, adjustable rate mortgages, their rates tend to be lower than fixed rate mortgages, but if you're not sure which one is right for you, give me a call, send me an email, and I'll be sure to point you in the right direction because it all depends on the type of investment you want to make and what your needs and wants are. How long you're going to hold on to the property, that's important. Question number 2, will I need private mortgage insurance? Another good question. Well, just in case for those of you who don't know what PMI is, which is private mortgage insurance, if you put down less than 20% on your mortgage, then you're gonna pay private mortgage insurance. And private mortgage insurance actually protects the lender, not you. Because I know when you hear the words insurance, you think, oh, it's here to protect me. No, it's here to protect your mortgage lender in case you default on your mortgage and you stop making your mortgage payments. So that insurance is important. If you put down more than 20% on the purchase of your home, then you don't have to worry about private mortgage insurance. But it's important for the lender, so this way we know that we're gonna be protected in case something goes awry, and it's definitely needed. And you know what? Not everybody has 20% to put down on a mortgage. So just think about this. If you're putting down 3% and the lender's giving you 97%, which they're the 97% owner of the property, you kind of want to make sure that they know that they're protected. Question 3, what is the difference between a pre-qualification and a pre-approval? Well, it's obvious. For me, maybe not for you. But a pre-qualification is based on a verbal conversation that you and I have, where I ask you a couple of questions, you tell me what you think your FICO score is, what you think your debt to income ratio is, and basically it's general information like how long you've been at your job, what's your wage, that sort of thing. And then I take your word for it and I issue a pre-qualification based on that verbal conversation that we've had. I don't like pre-qualifications personally, but they work for other people. Pre-approval is where I actually ask you, the mortgage loan officer actually asks you for documentation that's more personal, where we ask for your driver's license, we ask for your social security card, we ask for your pay stubs, 2 of your most recent pay stubs, 2 of your most recent bank statements, 401k statement, important details, because what we want to do is take a deeper dive to look into what you're saying, to see if what you're saying is actually true, and if it can qualify you, the information you provide can help qualify you for a mortgage. So pre-approvals actually carry more weight when you're going to submit an offer, especially for a seller who has multiple offers on the table. They're gonna look at your pre-approval and they're probably gonna consider your offer over a pre-qualified buyer, because pre-qualifications, when it comes down to it, let's say you get under contract, and then that's when we do our deeper dive, we may find out that actually the pre-qualification isn't good and the information you provided wasn't accurate, and therefore you don't qualify to purchase that property. Trust me, you do not want to find out that you don't qualify for a property after you're under contract or even after you've completed home inspection. So take my word for it, go for the pre-approval. It's a little bit more involved, but what you get away from, actually what you provide up front will save you the headache later on. Question 4, how much home can I afford? Well, that all depends. Depends on how much you make, depends on how much you want to spend, depends on where you're moving to, but I generally look at the 28-36 rule, which is 28% of your housing expense and 36% of your monthly total debt. You should take what you're making per month, multiply it by 36%, and that's how much your total housing expense, including your debt, should be. Now, depending on the mortgage product that you're applying for, if it's FHA, we can probably go up to 50% back-end ratio, but we want your front-end ratio to be under 40, to really be under 38%. And if you're conventional, 45% debt to income ratio. I know it's a lot of numbers that I'm throwing out at you, but when we talk and I fully explain to you in detail how that ties to everything else, you're gonna say, oh my gosh, I get it. That makes sense. So take your monthly income, multiply it by, just to be conservative, 40%, and see what that number looks like. That can generally tell you how much house you can afford. Okay? So hopefully that was a good explanation for you. Question 5. Can I get a mortgage despite low or no credit? Well, you can potentially get a mortgage with no credit or low credit, but with no credit, it'll probably take a little bit longer because we're gonna want for you to establish at least 3 trade lines, and they're easy. If you have a family member that can put you down on their credit card as a co-borrower, in a sense, where then they issue you a credit card, but they provide the credit card company your social security number. So then this way, when they issue the credit card, it's actually gonna report to the credit bureau. You know, you can see if you can take on some new debt, but not spend it up, just so that this way we actually have something that reports to the credit reporting agency. What I normally tell my buyers that take on a new credit card, depending on what the purchase time window is, what the time frame is, if we have a couple of months and you're willing to wait to get the stuff together, I always say, if you get a credit card, look at your limit, multiply it by 10%, maybe 15% that limit, and that's the maximum amount you should put on that card. Make the first payment, minimum payment, do not pay it off. And then by the next cycle, we should hopefully have a credit score for you from the credit bureaus. Credit bureaus are looking at your credit history and how well you maintain your credit. If you go up and down in spikes, or you're constantly hitting your limit, or you're going over your limit, that's not good. So trust me when I tell you, it's better for you to establish credit and then apply for a mortgage, depending on when your lease is due or when you have to move, because you don't want to be in a time crunch and then you're freaking out because you're in a bad position. And we can't give you a mortgage Speedy Gonzalez style. Question 6. What are the things I need to prepare when buying a home? Well, it starts with qualifying credit. Pull up your credit report, check to see what your FICO score is, your mortgage FICO score more specifically, which is what we look at. And also see if you have any collections, see if you have any lates on your credit card, see if you have anything on there that doesn't look right. Don't dispute. Just look to see and then wait until we have a conversation to explain what it is that you see on your credit report that might be cause for concern. Because at the end of the day, what we want is to have an understanding about your credit history. And what we don't want to see is you have any lates in 12 months. We don't want to see any collections within the past 12 months, and we don't want to see any charge-offs within the past 12 months, because then that's a big red flag. Unless something happened in your life where you had an extenuating circumstance that we can explain to the underwriter, but you know, it might be an uphill climb. So if we see that you have a lot of these blemishes on your credit report, we may turn around and say, okay, we might have to wait 12 months, which I know a lot of you don't want to hear, but if we get a deny from the underwriter or even from the automated underwriting system, we're gonna have to wait. So why not spend the next year working together, you and me, to get your credit score up, to clear up the blemishes on your credit report, so that this way when it's time, it's go time. You're ready to go. So hopefully that answered your question. Question 7, what not to do during the pre-approval process. I can't tell you how many people make mistakes, and I can't tell you the unfortunate stories that I've heard. Luckily, they've not been any of my bars, but I've heard some real sad stories. What you don't want to do, these are the most important do not do's, is you don't want to take on any new debt, meaning you don't want to take on a personal loan with a high interest rate, because if we've already calculated your debt to income ratio and we're right there at pre-approval, and then you take on new debt, that new debt can throw your DTI out the window. It can literally skyrocket, and then you won't qualify for a loan. So you don't want to take on any new debt. You do not want to be late on any of your credit payments. That's your car payment, that's your credit card payment. You don't want to be late on that sort of stuff, because when I tell you, it can come back to bite you. Because if the credit card company hits you with a late, it's gonna drop your credit score significantly. And if we're already at that minimum threshold, I gotta tell you, it may sink you, and then we have to figure out what the plan B, C, D, or all the way up to Z is, or we just might have to wait. Sometimes the credit card company will be nice enough to give you a one-time courtesy and clear that late from your credit card, and then they will send you a letter and you get that over to me, and then we can do a rapid rescore, but they're not always generous. Another thing is you don't wanna make large purchases. Don't buy a new car. I get it. If your car is in the tank and you're desperate and you can't get to me to sign your documents. If that's what you want to do, wet sign, take an Uber, take a Lyft, wait until after you close, and then you figure out what you're going to do about your car. Do not do anything while we're in the review process or underwriting process, or when you're in the process of buying a new home. Trust me when I tell you, you don't want to do that. And you also don't want to co-sign on any loans. You don't want to change jobs unless you're changing from a 1099 employment to a W-2, and there's a reasonable explanation like more income, then that will help you qualifying for a new mortgage. So trust me when I tell you, those are the don'ts. And another important one is what you should not do is overspend. You don't want to go over your credit limit, because then again, that's going to hit your credit score and it's just not going to be good. And then when we rerun your credit before closing and you've gone from, let's say, a 600 score, which is just at that bare minimum, now you're below 580, we're in trouble. So trust me when I tell you, these are the do nots you want to keep in mind, because what we don't want is for you to suffer, and we want you to close on your loan. So take my words, take my advice. Question 8. Can I prepay my mortgage? Of course you can prepay your mortgage, but it all depends on what kind of prepay you're talking about. Are you talking about prepay your mortgage in full? And if you are, then you should really contact Loan Care or your servicer to find out, or even look at your mortgage loan documents to see if there's a prepayment penalty. Usually there might be if it's within 6 months or within a year, but if you want to prepay your mortgage, meaning you want to make an extra payment or add a little bit more to pay towards your principal with each mortgage payment, so you're reducing the term from 30 years to less, or if you have a 15-year term mortgage to less, then yeah, that's a great idea, because it recalculates and then it actually every little bit counts. But it all depends on what kind of prepayment you're talking about. If it's prepaying in full, you definitely want to have a conversation with Loan Care or your servicer, or even just give me a shout and we can try to figure things out. But prepaying your mortgage a little bit at a time, so this way it reduces you from a 30-year term to 25 or 20, yeah, go for it. That's my advice. I don't see anything wrong with that. Question 9. Can I use cash as my down payment? Okay, just from that look alone, you know the answer is going to be no. Because we, as your mortgage lenders, need to be able to see the paper trail. We want to confirm that the money that you're using as a down payment for your mortgage is not mattress money. What mattress money means is that cash you might have in the house or in a safe or underneath your mattress, and we need to be able to verify those assets. And they should really be in your bank account for at least 2 months. That's why we ask for 2 months of bank statements, because we want that money that's in your bank account to be seasoned. Kind of like when you season something to eat, that's the same thing with your money. We want to see that seasoned asset in your bank account, so that this way the underwriter doesn't raise an eyebrow and say, we have some questions here. So if you have cash and you're planning on submitting an application with me to get your new mortgage, please get that cash in the bank and make sure you have it in there for at least 2 months before we get started, so that this way the money is seasoned and we're not going to create any issues or questions or problems that might get your loan denied. So trust me, that's not something that we want to do. And yes, mortgage lenders do not. We just can't accept cash. You can wire funds to the title company at closing. You can wire the title company your earnest money deposit. So yes, that's cash-ish transacting between your bank account and wherever it's going, whatever that destination is. But no, you can't come with $1 million in a briefcase to give it to us so that say, hey, accept my money as a down payment for my property purchase. Ain't gonna happen. Question 10. Are there any government programs that have 0 down payment? And yes, there are. 2. The first, if you're a veteran, active duty, or retired, you should qualify for a VA loan, VA mortgage, which is 100% financing. That's one of the benefits for our government saying thank you for your service to our country. We want to help you become a homeowner with this VA benefit. We're going to ask you for various documentation, your DD-214, and other documents to verify that you do qualify for a VA mortgage. But hey, why not? If you can buy a house without a large down payment, and maybe your real estate agent, wink wink, can get the seller to cover closing costs, win-win situation. So why wouldn't we want to do that? Second is USDA. Now USDA is very specific to an area that is USDA qualified. So what you want to do is you want to ask your real estate agent if they have any areas near where you are or in your target area that are qualified for USDA. And they might have to visit the USDA website to see if, and punch in an address and see if it's eligible for USDA benefits. And if it is, and you like the house and you qualify for it, I always say that if you qualify for conventional financing, then you should qualify for USDA financing because it's very strict and it's based on your debt to income ratio, and those limits can be kind of conservative. So, definitely there are two, but it's all about qualifying. If you're a VA, you have to be active or retired military. And if you're USDA, you have to qualify for that type of a loan, and the property has to be in a USDA area. Other than that, not that I know of. Those are only two programs with zero down payment. Question 11. What is the difference between PMI and MIP? So the main difference between PMI and MIP is the type of financing that you have. I can tell you, when you pay PMI, it's because you're applying for a conventional loan and you've put down less than 20%. Remember, that's the insurance to protect the lender in case you default on your loan and you don't make your mortgage payment or you don't pay your loan. MIP, mortgage insurance premium, is what you pay if you had an FHA loan. So, which is a government-backed loan. And like the PMI loan, basically they take the annual charge and they divide it by 12, and then they add that to your payment. And that's your PMI or MIP payment. So it's basically mortgage insurance if you've put down less than 20%, and the calculations are very basic. And yes, if you can avoid paying PMI or MIP, put down 20% or more in the purchase of your property. If not everybody has that much money or that kind of money in their bank account. So why not? And then, you pay the PMI or MIP, and then if you're doing a little bit better and interest rates have dropped, the market has been really good to you, then you can refinance your property, and then you might be able to get rid of it that way. So hopefully that answers your question. Question 12, what is down payment assistance? Well, down payment assistance is a program that can be county-based, it can be local, state, or government. And it's a program that's designed to help you, first-time home buyers, qualify for a mortgage with down payment or closing cost assistance. Not every first-time home buyer actually has assets in their bank to cover their down payment or their closing costs. Usually they have one or the other or none. But down payment assistance, the program itself, and there are so many out there that are waiting for buyers like you to come and knocking on that door with me by your side. But down payment assistance programs are different. Each one has their own qualification requirements. Some have income requirements, some have location requirements, some have credit score minimums. So meaning that if you don't meet the credit score threshold, you ain't gonna qualify. And also, some of them have restrictions on credit, income, asset restrictions, location. It's better for us to have the conversation. If you're interested in down payment assistance, we'll get you a pre-approval, and then while we're going through the pre-approval process, we'll see which program best works for you. I hope that answered your question. It's a program designed to help you qualify for a mortgage with no money down, and it usually comes in the form of a second mortgage with 0% interest that can either be repayable or payable, and the payments sometimes can be deferred. Sometimes don't start until 5 years into the loan, and if it's repayable, then that's when it starts, 5 years into the mortgage. Or sometimes you don't have to repay it, and then it just gets cleared. As long as you stay in the property a certain amount of time, then the down payment assistance that you received is considered a gift, because the program says, hey, you've been good, you paid your mortgage on time, no lates, you've met the time frame requirement, the house is yours with no strings attached. Question 13, does more down payment make for a better deal? Yes. If you have the money, yes. More down payment makes for a better deal because then the seller sees that you have the cash, the assets needed to close the deal. But more importantly, more down payment helps you lower the principal or the purchase price of the property, ultimately lowers your mortgage payment. So yes, more money can be beneficial to you in many different ways if you're gonna put down more money. Not everybody can, but yes, it can help you actually land the contract for the property that you want, lower your mortgage payment, and just make you look really good on paper. If you're submitting an offer on a property that has multiple offers, the seller might look at your financing to see what kind of a buyer you are. They'll look at your contingencies to see what you might be asking for, but also they're gonna look to see how much down payment you have, because that money goes into escrow. And if you, for some reason, don't meet your contractual requirements and you try to pull out of the deal or your financing is denied because of something that you did, that money, guess who it goes to? The seller. So you don't want to mess anything up. If anything, you want to use your due diligence period, which is your inspection period. You want to use the opportunity for the appraisal. There are different opportunities for you to go through while you're under contract. If you don't meet that milestone, let's say if the property doesn't clear inspection and it looks great on the outside, kind of like a Mona Lisa, but when you get up close with the inspector, it's awful. That is an opportunity for you to get out of the contract and you get your earnest money deposit back. Or if the property doesn't appraise and it appraises lower than what you're going to buy it for, then there's an opportunity to renegotiate. And if the seller says no, then it's a release and cancellation, and then you get your earnest money deposit back. But yes, does more down payment make for a better deal? Yes. But you want to be mindful that you pay attention to the terms of the contract, and you have to work closely with your realtor to make sure you meet your milestones. And if something goes wrong or something doesn't pass the sniff test and it's the right time to get out of it, get your money back. If not, I'll see you at the closing table. So those were the 13 most frequently asked questions, you guys. And I hope I was able to provide you with some information because I have so much of it up here and I want to be able to share it out there. But hey, keep asking your questions, keep sending us your comments and your thoughts because we want to know what you need so this way we can be here to help you. So again, I'm Felix Mercado, mortgage loan officer and producing branch manager for Nations Lending Corporation. And today, I just answered 13 of your most frequently asked questions for first-time home buyers and home buyers that are fabulous like you.